Peter L. Bernstein, A Primer on Money, Banking, and Gold, Peter L. Bernstein's Finance Classics. Embark on a journey through the world of finance by delving into A Primer on Money, Banking, and Gold by Peter L. Bernstein. This book summary unravels the intricacies of money, its abstract nature, and its connection with gold. Understand the impact of money supply on our economy, learn about the role of banks in money creation, and explore the ways in which the Federal Reserve influences the money supply. The book provides an overview of the history and evolution of the U.S. financial system, highlighting key events such as the Great Depression and World War II. Get ready to demystify complex notions and gain valuable insights into the fascinating realm of money, banking, and gold.
The abstract nature of money. Money, once represented by physical objects, coins, feathers, or beads, has evolved into abstract accounting entries in the hands of bankers, shaping complex societies. Gold, while being a tangible commodity, derives its monetary value from people's decisions, similar to money. Economic mismanagement leading to price fluctuations can impact people's financial lives. Despite its abstract nature, money has become a fundamental aspect of our lives, shaping relationships and opportunities. The impact of money supply. Inflation affects people's decisions on how much money to spend or save. When people's income cannot keep up with inflation, they may cut expenses, leading to a decrease in demand and ultimately job losses. Regulators must ensure that there is enough money in circulation to match production without causing inflation or deflation. In the end, individuals determine how much money is needed as they choose whether to spend or save their money. The money supply has a real impact on the economy, and it is essential to maintain a balance to avoid adverse consequences. Maximizing cash. Keeping cash in a no-interest checking account to meet daily expenses is a common practice, but lending excess funds to earn interest is a smarter option. Nonetheless, the amount of cash to lend largely depends on the interest rate level, which should cover the risk and inconvenience of lending. However, cash's demand or liquidity can lead to economic crises, as observed during the Great Depression when lending reduced due to high risk. The power of banks in creating money. Banks, not the government, create money in the form of entries on their books. Banks keep cash reserves on hand and invest money in highly liquid interest-bearing securities to ensure they have enough cash to satisfy people who want to withdraw money. Banks make money by lending out more than they receive in deposits, and every deposit connected with a loan lets banks create more money. The creation of money is an accidental yet potent side effect of their lending activity. To lend money, banks need depositors to put money in their accounts, but the banking system as a whole does not require more money deposited to create money. The circulation of loans and deposits between banks within the system creates more money. The Federal Reserve System. The Federal Reserve System was created by Congress in 1913 to prevent another banking crisis similar to the one in 1907. Comprising 12 districts in the U.S., each with its Federal Reserve Bank and Board of Directors made up of bankers and non-bankers, some appointed and some elected. There are 7 members of the Fed's Board of Governors who are appointed by the President, and they serve for 14 years. The Fed regulates the flow of money by influencing member banks' lending. Fewer than half of the country's banks are members of the Federal Reserve, yet they hold the majority of deposits in the U.S. Federal Reserve banks act as banks for banks and lend only to Federal Reserve System members using an interest rate called the discount rate. The Fed has 3 ways of controlling the money supply: reserve requirements, lending to banks, and buying or selling securities. Though the Fed does not frequently change reserve requirements as it affects banks across the board regardless of their reserve positions, the more a bank has to carry in reserves, the less it can lend and vice versa. The Fed's open market operations refer to its buying or selling of securities, which increases or decreases liquidity in the banking system, increasing or decreasing bank reserves. U.S. money and gold reserves. For much of the 20th century, the U.S. tied its money supply to gold held in Fort Knox. However, this ended when gold outflows became too significant. If foreign governments lost confidence in the US dollar in the mid-1960s, they may have demanded gold for their dollars. This risked causing a run on gold, as the US may not have had enough gold to meet demand. Even if chaos had followed, the markets would have adjusted the dollar's value to its exchange rate eventually. The confidence game. Even though the US dollar is not backed by gold anymore, it remains a trusted currency. This trust is crucial, as there is no guarantee that banks have enough cash to cover all deposits and withdrawals. During World War II, cash withdrawals exceeded deposits due to mistrust. The Federal Reserve ensures there is enough cash by lending at its discount window, while the US Mint prints more currency as needed. This shows that public confidence is what gives the US paper money its value. War financing in the US. Prior to World War II, Europeans sought safe haven by investing in the dollar and gold, and this increased the commercial bank reserves, which were not proportionately lent due to low interest rates and a shortage of good borrowers. As a result, monetary policy failed to stimulate spending. However, the US had idle capacity in a significant amount of gold, which allowed it to finance the war. The government borrowed approximately $210 billion, $70 billion of it from commercial banks, leading to the creation of new money. Despite an increase in government debt, interest rates remained low, and inflation was controlled through rationing and price control. The evolution of the Federal Reserve. In the aftermath of World War II, the U.S. government abandoned price controls and rationing, leading to a surge in consumer and wholesale prices. Investors sought better returns from securities, which prompted the Federal Reserve to purchase government securities from its member banks. However, the Fed's ability to buy open-ended volumes of securities at fixed prices was limited, which led to the 1951 Treasury Federal Reserve Accord that relieved the Fed of this obligation. From there, the market determined pricing, and in the late 1950s, the Fed restricted the money supply by reducing open market operations and requiring member banks to borrow from the discount window. This led to businesses having difficulty borrowing from member banks, which caused interest rates to rise. The Fed then encouraged public savings, increasing the ceiling rate that banks could pay on interest-bearing accounts. This resulted in the public reducing its checking account holdings while increasing savings and time deposits. Compared to the 20% demanded for demand deposits, banks had to hold only 4 cents against these accounts. Overall, these policy changes have shaped inflation and production expectations over the years. The monetary crisis of 1966. In 1966, the U.S. faced a monetary crisis due to high national spending on the Vietnam War and limited interest rates. The government sold unfamiliar assets to raise money, which led to higher interest rates. The crisis was resolved by changing borrowing policies, proposing tax increases, and easing the money supply. This crisis taught policymakers to balance monetary policy with fiscal policy, and that money demand depends on expectations. The author defends the positions taken in the book over 40 years ago and argues that gold puts an arbitrary limit on economic activity.
Having delved into the world of money, banking, and gold in Peter Bernstein's book, we have explored the complex relationship between these elements and the economy. We've seen how banks play a pivotal role in the creation and distribution of money, and how the Federal Reserve strives to maintain balance in the money supply using different tools at its disposal. Additionally, we've traced the historical underpinnings of the U.S. financial system and the role of gold and its limitations. By understanding the insights provided in this summary, we can better comprehend the relevance of money and banking in our everyday lives and the importance of balanced monetary and fiscal policies for a healthy economy.